In this video, I will review a subscriber's portfolio. He shared his portfolio with me. You have all his positions over there, and you will have my clear opinion about the picks, about the different positions, the portfolio allocation, the portfolio risks, the different risk reward of each of these positions. So if you own, maybe you own some of these positions, so you will have my take about these companies, or maybe you will have some fun because we will discover some businesses together. Some businesses I know, some businesses I've never heard of them. So we will review everything. We will take our time so we can do a proper analysis of this portfolio. Thank you, Amin, for sharing your portfolio. This is a portfolio of 300,000 euro here, and you've been investing for a while. So congrats. That's a very good allocation of a portfolio. Thank you for taking the courage of shooting your portfolio here, and we can start. In case this is your first video watching this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in quality assets, quality stocks, quality companies, the Warren Buffett way. So yeah, let's start. And so I'm in here from Germany. This is why the amount here is in euros, and we can take a look at all your positions. You have the weighing here. Okay, very well. Let's start from the biggest companies in your portfolio, and then we'll go on the way down. The first one is, oh, it just changed. Let's start with Microsoft. The first one is Microsoft in your portfolio. If you wanted a blue chip business, if you wanted a safe haven, Microsoft is a very good example. For all your picks, I will take a look at several websites. Maybe I will take a look at the Guru Focus, maybe Stock Unlock, maybe FinChat, Fiscal AI. So I suppose everybody watching this video knows Microsoft. There was a recent interview from Monish Pabrai and his opinion about all the Magnificent Seven. Microsoft is the best one when it comes to profitability, sustainability of the moat, and resilient business. You can have anything happening in the world. Microsoft has recurring revenues and will continue to make money in the future. So that's your biggest position. I don't know when you bought Microsoft. You have the P&L here, so you can guesstimate where he bought. Okay, I don't have access to this. So you can guesstimate the price, the buy price. This is obviously a quality business with a quality management team. And the stock recently declined for a while. I mean, it went stable for many months, many quarters, and then declined like everything in April 2025, like everything. But if you look at the market drama, the market correction of March, April 2025, it's about tariffs, it's about geopolitical conflicts, it's about tensions in the world. Will it really affect Microsoft? My answer is I don't think so. I don't think so. You will still continue to pay your subscription to Microsoft. And they have built this brand. They have building this huge ecosystem with huge switching costs. It's almost impossible to live without Microsoft. When you are a company, enterprise, I know this. You have companies, and inside the companies, you have a Microsoft pack when everybody uses Excel. Even in funds, right? In hedge funds, investment funds. When I was working in Paris, we were in an investment fund. Everything was done on Excel, right? If you want to move away from Microsoft, and let's say you want to use a Google Sheet, that means you want to move all this data in this big cloud, thousands of Excel files to go to Google Sheet. There is maybe a risk of leak. The data can be compromised. You can have a leakage of information. You can remove the information. You can lose the information, lose some files. So there is a risk of files that are lost, leaked to the public, some private information we had with private conversations with CEOs. You don't want that to leak. This is private information. Literally, you have a non-disclosure agreement with them. You don't want to take any risks. So to that extent, investment funds will continue to use Excel. You don't want to move away from Excel to go to another provider. Even if it's a little bit more expensive, anyway, you stay with Microsoft. And the CEO, Satya Nadella, has said this a few quarters ago, a few years ago during an interview, saying, if you are not happy with price increases for Microsoft, you are free to use Google Sheets. This is your only alternative you have now. And people don't want to use Google Sheets. And I agree with them. The interface, the user experience is very good on Excel. And once you are used to using Excel, you just don't want to change. And Microsoft has built this big ecosystem for many years now. All the companies use the same software, and to that extent, I would say the majority of the revenue is recurring for Microsoft. And when you have a recurring revenue, that's a very high quality revenue. That's, let's say, that's the best kind of revenue you can have. A high retention rate, you don't have any churn, people come back, you have a loyalty towards your customers. I'm currently reading a book about hidden monopolies saying customer loyalty. Customer loyalty, you want to build a huge moat when you compare yourself to your competition. You want customers to love your services, to love your products. And I believe Microsoft falls in this category. So it's a big company, and because it's so recurring, so entrenched into the world, it can continue to grow. The margins are extremely high, obviously. It's a software company, 70% gross margins, net margins of 30% and increasing. And the PE ratio right now is 30-35. Yeah, this is maybe the main risk you can have. If you look at the revenue here, up and to the right, here in blue, net income up and to the right. Strangely enough, if you remember, in 2020, 2021, the net income improved drastically for some big tech companies. And this is the first time in history when you have large companies like mega caps that grow faster than small companies. Very strange scenario. I agree with you. At the time when you had the Nifty 50s, for example, in the 70s, you had all these big conglomerates, the Home Depot, the Coca-Cola, all these big companies, including Kodak, etc., or McDonald's, Walt Disney, all these big companies that grew a little bit less over time. You become big, you become an elephant, you become complacent, and then your growth rate slows down. But now we are in a new era. This is the beginning of the digital world, and Microsoft was the biggest company on earth at the time. It continued to grow at a faster rate than small caps. So that's some scale. Not a lot of companies have the kind of scale Microsoft has. So I told you several kind of moats. The branding, the switching costs, the customer loyalty, and here we go. Here is another one. Economies of scale for such a big, profitable company without any debt. Look at this, the debt and the cash. You don't have any debt problem that needs to be paid off. They have a lot of cash. And look at the free cash flow up and to the right. This is beautiful. Microsoft is such a beautiful investment. You just want to not overpay for Microsoft. And you can go back to sleep. This is definitely a buy and hold investment, I would say. If you go and check the valuation for Microsoft, what has been the PE ratio over time, or price to free cash flow, that would be the same. Look at this. This is your PE ratio over time. Look how cheap the business was in 2011. Obviously, you had some worries in 2010. People said that Microsoft was dead. And it turns out it was not dead. It was very well alive. They shifted to the cloud. They shifted to being a leader almost everywhere. And they copied what worked. And now, if you look at 2020, or a little bit before, PE ratio of 25. After 2020, PE ratio of 35. During the recession in 2022, PE ratio of 25. Okay. And the capex started to increase massively. And now 35, it dropped recently this year in April 2025. And now it's up to a PE ratio of 38. I would say it's a tiny bit expensive right now, but in April, it was a very good time to buy. I bought something else during that time, so this is the reason I didn't buy it. But it's definitely a buy and hold business. By the way, if you want more information about the history of Microsoft, you have a recent interview with Steve Ballmer from the Acquired podcast. Here we go. From June 2025. Great interview. It's a 3-hour long podcast, so it's great. And it will tell you a lot more about how Microsoft works, how resilient this business is. So having Microsoft as the largest position in your portfolio is very safe, I would say. What Joel Greenblatt is saying is you want the big portion of your portfolio, your biggest investments, to be the safest ones. For example, my biggest investment in my portfolio is Brookfield, something that is very safe. You can't really disrupt Brookfield. This is not hype, this is not fancy, but you have a strong management team, strong operations, strong growth. You want your biggest company in your portfolio to be the safest one. And to that extent, congratulations. I mean, Microsoft is very safe. You have a great management team and they will continue to operate at a very large scale. They can continue to grow fast. They can continue to grow in cloud with Asia and continue to be very profitable in the future. The only thing is valuation, but now I don't think it's overvalued by a lot. I mean, it's not a good moment to sell, right? Maybe I would not buy at current prices, but it's a hold. So it's definitely a hold. By the way, in this video, I will maybe talk about buying businesses, selling businesses, holding businesses. Nothing I say is investment advice, but you asked me for my opinion. Here it is. Beautiful business. It's a buy and hold investment. Forward P ratio of 33, 35. Yeah, the capex is worrying, but so be it. It's a tech company and they have some SBC, but nothing really immense. Okay, very well. They are doing some buybacks and doing some small dividend. Okay, very well. Let me move on to the next one. By the way, I wanted to thank you for all the nice comments you said. I don't know if you are watching this video and you know he's commenting almost all my videos. So, and it's been a while. So for many months, thank you very much. You deserve this. So you will have the analysis you deserve. The next one is ASML. ASML is again 13% of the portfolio. It's not as safe as Microsoft, obviously. So people watching this video, maybe you don't know ASML very much. I definitely recommend a book that is maybe here. It's called The ASML Way. Maybe you have this. Let me check 20 seconds if I find it. No. Seeking wisdom. Anyway, I think it's not here. It should be in the other room. Okay, anyway, you have a book called The ASML Way. The ASML Way. Great book. If you are a shareholder or you want to be a future shareholder of ASML, please watch this book. It will be very enlightening. Another book I can recommend is Chip War. Chip War, one of the best books, maybe the best book you can have when it comes to the chip industry. Manufacturing, competition, global competitors, global threats, etc. And ASML has no competition. You are a monopoly in the EUV market. So let me read the description in case you don't know this company. It is the leader and monopoly. 100% market share. This is crazy. In photolithography systems used in manufacturing semiconductors. Photolithography is the process in which a light source is used to expose circuit patterns from a photomask into a semiconductor wafer. You have a very good investor called Dave Canteseria that is investing in ASML right now. If you don't know this investor, let me show you who it is. You have a big investor. The fund is called Valley Forge Capital Management, and they've been investing in quality assets, right? Maybe I can find it through it. No, that's fine. FICO here. I will find it through him. FICO. And he has outperformed the market for many years. He invests in quality assets. He invests in quality assets when they are at a discount. And he recently bought ASML. It's a starting position, but it's only the beginning. Maybe he will buy more in the future. So if one of the best investors on earth focus on quality assets, buys ASML, that's a sign of approval. So congrats, you are in the same boat as Valley Forge Capital Management, Dev Cantisseria. And ASML is cyclical, yes, but it has great margins, very profitable, net margins of 30%. And look at this, look at the revenue over time growing very nicely up and to the right. Net income is more cyclical, but still you have up and to the right. Look at the free cash flow. They invested massively during 2022. So this is the reason why the free cash flow is so decreasing and down since 2022. And now seems like free cash flow is up again. They don't have a debt issue. They have a lot of cash. The ROIC is good. ROIC is return on invested capital. So that shows how efficient a business is. For each dollar that you invest in the stock, how much dollar do you get? How many cents do you get? And 20% ROIC is very good. And they are doing buybacks. And now, if I believe, I've seen this on Twitter, they are doing buybacks right now. The management is quite smart and they know when to do buybacks. They know when to repurchase their shares. The best way to do buybacks is when the stock is cheap. So when a management is using their cash to repurchase their own shares, that means they invest in themselves, right? They invest in the stock like you would invest in the stock. It's a sign that the stock is cheap. So it's a good indicator. When they do buybacks, they think it's cheap. Maybe it's a good time to buy. Look at this. In 2021, 2022, they did some buybacks. Maybe it was a good time to buy. And as you know, this chip industry is very cyclical. Up and down, up and down, up and down. And now we are down. Next question for you. Do you think the next leg will be up? And do you think the chip industry will thrive in the future? With all the moves that you see in AI right now, do you think it will grow exponentially? Do you think it will continue to grow massively and the leg is up and you will have an upside potential that will be immense? Look at the past 10 years. You have some cyclicality and it's up, down, up, down, up, down. And as the scale grows, as the technology advances, ASML thrives. You have more orders, more machines, you have immense pricing power, and they continue to sell their big machines the size of a bus, a school bus literally, and you see zero competition. I can definitely recommend a video from Daniel Pronk about ASML. You can type on YouTube Daniel Pronk, Monopoly or Moat, and you will find this video. It's a great video that goes very deep, explaining what is the moat of ASML. Let me take a little bit of coffee and we'll continue. What can we say about the valuation right now? Yes, it's down, but the P ratio is 30. So again, if we do the same exercise of comparing the valuation to the past, what is the same stuff, right? You have different tickers. The stock is listed in many stock exchanges. The P ratio for this business, because it's highly cyclical, the P ratio is changing from from 20 to 30 to 20 to 65. And then we reached extremely expensive levels here. Then in 2023, we reached a P ratio of 30, then it rebounded to 50, and now 30 again. Same thing in last April, like a few months ago, it had a P ratio of 30. Do you think it's really reasonable? For this business, I would recommend to look at the earnings, not the free cash flow, because of the volatility. If you look at the free cash flow, good luck analyzing this business using a free cash flow model because it will widely fluctuate because of high capex. I can show you what I mean. It's the way the business is financed and all the big similar companies are doing the same thing. If you look at the KPIs, income statement up and to the right, wonderful, and everything improved with time. If you look at the earnings per share, It's cyclical, but up and to the right. And now if you look at the capex, it's completely huge. The capex is just massive for this company. They need to reinvest massively in their business. And because it's very cyclical, you see these trends up and down, up and down. That is impacting the free cash flow. So I would not recommend to use the price to free cash flow to judge this company. What are the big KPIs is what are the sales, how is the capex moving, and what are they doing with the cash. And apparently the cash is moving in the right direction right now. So I like ASML. I think for investing in ASML, you need to have some conviction in the future when it comes to this industry, the chip industry. You need to know something about EUV market, what they sell exactly, the lithography, and you need to know what the management is doing with the cash. Now we are doing buybacks, so maybe the stock is cheap right now. And all these big traits, big monopoly, pricing power, they are in a niche market that nobody is touching, is available at a PE ratio of 30. So maybe it's a good time to buy actually. I would not buy it right now, but if it drops to a PE ratio of 35, maybe. If we have a prolonged period of going down for the stock, maybe I will buy it, because it's a very high quality asset. But I'm not an expert on this topic. I've read a couple of books about this company, but I'm definitely not an expert on this one. And I would not know if you have any risks. For example, every year for ASML, you have threats of Chinese competition. Chinese competitors are coming and eating your lunch. You have threats from potential countries, from Japan that is coming, and they want to disrupt the EUV market. Spoiler alert, every time this is not a real competitor, they fail. Because it's very hard to have this kind of machinery. It's very hard to have these big machines with the kind of treatment they have. You don't need any dust. You need to be very clean, and the monitoring of the machines is very costly. And it's very hard for companies to be profitable when you have all these costs. ASML has survived for so many years because it was financed by other companies. So literally, other big companies in the chip industry helped ASML survive, or else ASML would have died. And I don't know if Chinese competitors have some help. I'm guessing they will have some subsidies from the government, but is it really sustainable? I'm not so sure. So to that extent, you have an uncertainty for ASML. Anyway, very high margins, monopoly for the moment, monopoly for decades now, and since 2014, 2015, everything has improved for ASML. The pricing power got better, the demand got better. And if you think the world will need more chips in the future, you think this industry will continue to grow, well, ASML is a big player you can bet on. Out of the bunch, you can bet on ASML. I have another company that is, I would say, riding the wave, surfing the wave, is Lam Research. I have it in my portfolio. I think it's a little bit more simple to understand. And it follows the same trend, right? I think you have Lam Research on your portfolio. Lam Research, you have KLR Corp. Lam Research is here. So the subscriber here sharing his portfolio owns a few players in this industry. Big allocation towards ASML, but you have a few other similar companies. And you see up, down, big capex, margins, up, down, and the trends are very promising. Same thing, PE ratio of 25. Lam Research is a little bit cheaper than this. So we'll talk about the chip. We'll come back to the chip industry later on this video because we will talk about Lam Research. Let me continue. I hope you like this format. This is pure freestyle and I like it actually. Thank you for sending me your portfolio. It's a great exercise and I think it will be pretty helpful for all the people watching this video that are struggling to analyze businesses. How do you detect a moat? How to analyze businesses? What is important? What is not important? And by the way, if you want me to help you build a strong portfolio and improve your investing skills, you can book a free call with me. There is a link in the description to book a free strategic call with me so you can see if I can help you pick these kind of stocks, analyze these kind of stocks so you can build more confidence. I have a coaching program. We have weekly calls with students. It's very fun and we learn a lot. So these are motivated people that want to improve their portfolio, to improve their returns over time. And so far, the performance has been very nice. So I don't want to complain about it. Life is good. And if you want to be part of the journey, you can book a free call with me. This should be the first link in the description. Okay. Third company is MSCI. I know MSCI quite well because I'm currently doing the deep research on this one. I think that's the deepest deep dive I've done in 2025. So for sure, I will have some opinion about MSCI. It's 12% of your position. You have a pretty concentrated portfolio. 12%, 13, 13. I mean, if you look at the top 10 position, 1, 2, 3, 4, 5, 6, 7, 8. Yeah, 8 companies will be the main driving force of your portfolio. Pretty concentrated. You have 13 plus 13, 26, plus 12, 26, 38, 48, 58, something like this. I mean, this is like 60 or 70% of your portfolio, the main driving force. Okay, let's move on. MSCI, in case you don't know this company, you have found the perfect video. And you have a company that is a software company, very asset-light company. They have 4 key segments. One is they create an index, the MSCI World, the MSCI China, the MSCI Europe. You can create custom index, whatever you want. So that's a great benchmark for funds. Funds, investment funds, compare themselves to this benchmark. Okay, so they compare. Imagine if you are an investment fund in Europe, but you have a global exposure. You buy a little bit of China, a little bit of Europe, or of Asia, the Philippines, and the US, Canada. Would you really compare yourself to the S&P 500 if you have a global exposure? I don't think so. That's not the same game. So let's compare yourself to the MSCI World. If you want to compare yourself to the MSCI World, you need this benchmark. And you will have to pay MSCI to use this benchmark. So MSCI comes to you and say, okay, you want to benchmark your fund against us? Okay, let's pay, $10,000 so you can use your benchmark. And we will give you the value of the benchmark every day. So you have an update, so you can compare yourself to your benchmark every day of the week, every day of the year. It's a cost. It will not be free to compare yourself. And you are a fund. You use a benchmark. And after 2 years, the price of using this benchmark goes up by 20%, for example. It will be quite stressful to change your benchmark. You have built your trust, you have a fully fledged fund, you have your benchmark, you compare yourself to the MSCI World, and you can say to your clients, we are outperforming our index for the past 2 years. If you change your benchmark because the price is getting too high, you want to change your benchmark for some reason. If you change your benchmark, you destroy your track record. Your track record means nothing. So fund managers are kind of forced to pay MSCI every year to be able to compare yourself to the benchmark, to see, okay, we have a long track record of 10 years of outperforming the index. Look at the chart, it's beautiful. So they will pay up. And MSCI knows this. So MSCI is increasing their prices almost every year. I would say roughly 30% of the revenue increases from MSCI are going through price increases. Like 30% of the revenue driver is through only price increases. Not more customers, not more volume. No, just price increases. It shows pricing power for MSCI. First sign of a moat. You have sticky customers, switching costs. It's a cost to change your provider of a benchmark. And MSCI has been doing so for decades now. It was part of Morgan Stanley. Here we go. MAS stands for Morgan Stanley. And they have done a spin-off in 2007. You have the CEO, Fernandez, that was here since 1998 or something like this. The CEO owns the CEO and founder, owns 3% of the company. So some decent insider ownership, owner-operator. So I've talked to you about the benchmark, so sticky, etc. This index segment has 75% EBITDA margins. Very profitable. That's the crown jewel. That's the golden goose. Very, very sticky, very recurring, very asset light. No additional cost. There is no incremental cost of having a new client. Literally, MSCI is just giving the benchmark, giving the index. And if you want a custom index, let's say you don't want a benchmark you don't want the MSCI World, because you say, no, we invest in ESG, so we are an ESG fund, we want an ESG benchmark. MSCI says, okay, sure, let's create a custom ESG index for you. What do you want? You want some exclusion? Okay, let's exclude weapons. Let's exclude tobacco. Let's exclude all the companies. Let's exclude all the fast food chains, maybe, if you don't consider it ESG. So be it. It will be a cost. To create your custom index for you will be a cost. So instead of paying X amount, you will pay a little bit more because MSCI has created a new index for you. By the way, that's a great way to outperform a custom index. If you are a fund and you don't provide a lot of alpha, just create a custom index with bad companies that you will very easily outperform. It's a great way to fool clients into thinking you can be a great investor. You just benchmark yourself against a shitty benchmark and life is good. You are a decent investor outperforming your index. Okay, so that's the first one. That's the index segment. Index segment is 55% of the revenue. So half of the revenue from MSCI comes from index. By the way, I've seen 0 videos talking about this, about MSCI, this kind of analysis, like the way I did to you. So please leave a like to this video. It's a long video, and please leave a like for the YouTube algorithm. So that would be interesting. The second part of MSCI, so we said 50% index, 25% of the revenue, that's analytics. If you need additional data about the companies you have in your portfolio. If you need specific data, risk-adjusted data that you need on a daily basis. I have worked in investment funds and I've seen the risk department asking this kind of data every day. You want to tell your clients on a daily basis what is happening. Some clients will call, you need adjustments, you need regulation, so you need these risk metrics. So you need analytics. MSCI is giving you the analytics and you have to pay for this. So the margins are not that high. You don't have 75% margins. You have a little bit less. You have like 50% margins, maybe a little bit less. Let me check. I'm using this website, Fiscal AI, to know all the segments and all the margins. By the way, if you want to use this website, you have a discount code in my description. You have a link. Click on this one. You have 2 weeks for free. You don't even have to put your credit card. So you can just test it out for 2 weeks. And I have the pro version. I think it's great. You have all the KPIs. Use it whatever you want, guys. But use my link. So you will have a discount. And I will get some money out of the referral. So it's a win-win for everybody. Look at the segment and KPIs. Comment size. The index revenue, look at this line, it was 50% of the revenue, 50, 60, and now 50%. So index, half of the revenue. Analytics was 45% of the revenue, and then the share of the pie has decreased, and now it's only 25% of the revenue that comes from analytics. Okay, what are the margins for this analytics part? Again, let me do a quick reminder. Index EBITDA margins, so the first segment about index, 75% EBITDA margin. Okay, very profitable, crown jewel. The second one is, where is it? Analytics EBITDA margin, 50% EBITDA margin. Can you name 10 businesses with this kind of margins? It will be very hard. So very profitable, and the profitability has increased. More data, more pricing power. The third segment is ESG. So ESG is very new. Since 2019, it was 5% of the revenue. Now it has become 11% of the revenue. So nothing big it's not part of the story. It will not change the investment thesis for MSCI, not at all. It's very recent and it grew a lot during COVID. This is the reason why the stock went up a lot during COVID. Look at this, COVID, and then boom, you have a lot of revenue growth that came from ESG, and Wall Street and everybody extrapolated this kind of growth into the future. So the expectations were really high for MSCI and the ESG segment. And then we learned that the ESG trend was a fad that was only hype and unprofitable, and it was becoming victim of its success because political parties started to talk about ESG, and then it became a weapon of political stuff. So companies, including MSCI, said, oh, let's rename the ESG into sustainability, because we don't want to be associated with the ESG world. We just want sustainability, climate, but let's reduce the investment into ESG. It's not that profitable. Let's focus on index, very profitable. Analytics, very profitable. This is a great sign of flexibility from management. If you look at recent interviews, this is what they say. And if you don't know what I'm talking about, please do some research about MSCI. You have great free content on the internet. You can have all this data. And again, I can help you with that. You can book a call, actually. Okay, so let's see the custom metrics. I created this custom metric, the ESG EBITDA margin. Here we go, 30% EBITDA margin. Yes, pretty decent. Pretty good, but I would prefer the other margins. And then the last part, where they make money, is private equity. It's called all other operating revenue. It's 9% of the revenue. It's really not what will move the ship, actually. And the margins for the private equity part are 25%. So what I love about MSCI is the biggest segment, index, is the most profitable one by far. And this is what the company is focused on. They recently hired a veteran of MSCI, somebody that worked for MSCI in the past, to improve the index segment. I think it was in 2023, I have a doubt. And they rebranded the index segment, more custom metrics, more custom data, because you had some complaints about MSCI. That would be pretty interesting to you. You had some complaints for MSCI because of, price gouging. You increase the prices too much, but the value of the benchmark is the same. So customers were not really happy to pay higher prices. They were complaining, but still paying because you have high switching costs like Microsoft. So to some extent, the business model of MSCI is very recurring and sticky like Microsoft. And then in 2022, 2023, they said, okay, customers are not really happy with the price increases. They don't think it's worth it. So let's increase the value they get. So this is exactly what they said. They created MSCI One, so a huge software that centralized everything, very clean, very efficient for funds or any asset managers. And they implemented the software, climate, new data, so you get more with your money. So clients are more happy right now. You get more value with the same amount of money. So you can justify the price increases by a lot more. And seems like it's working. We will see in future years if they continue to increase the prices, but seems like it's working. So I've talked to you about the moat, the quality of the business, the different segments. What about the growth rates? What about the margins? If you look at the margins, the gross margins are 80%. Beautiful. Operating margins, 50%. See how profitable it is? It is just beautiful. Net margins, 40%. Free cash flow margin, 47%. It's huge. And look at this. No cyclicality whatsoever. The revenue is up and to the right. Look at this in blue. The net income is up and to the right. And we are living in a world with inflation. Companies that will thrive in this kind of environment will be companies with pricing power that can increase their prices to offset the costs. So one, MSCI has 80% margins, gross margins, so they can have immense pricing power. They can increase the prices, so they can offset inflation. And two, they don't have a lot of costs. They don't have a lot of capex. The capex is very minimal. I have created this custom metric 8%. So the capex is 8% of the operating cash flow. Very minimal. They don't need capex to grow. They have the infrastructure and they don't need reinvestment. They don't need costs. And look at this. The net income is up and to the right. The free cash flow is up and to the right. Look at this. Zero cyclicality. You are paying for capitalism and funds. And they are doing buybacks with the cash. What do you do with the cash? You do buybacks and you do dividends. A dividend yield of 1%. Let me tell you something else. Let me show you the free cash flow here. I've seen nobody on Twitter or YouTube talking about this. Let me show you the free cash flow. Where is it? I'm looking at MSCI. Come on, show me the free cash flow. Don't I have the free cash flow? Isn't it working? That's strange. Cash flow statement. Yeah, it should be a bug. Free cash flow is here. Okay, now that's the chart for free cash flow. Up and to the right. And let me show you the buybacks. So the amount of capital that is being given as share repurchases. And the dividends. Most common dividend paid. This one would be good. Okay, now that's a complete mess. I agree with you. And let me stack all these bars and let me tell you something. What you can see is the allocation of free cash flow towards buybacks and dividends. At the top of this document, you have the free cash flow up and to the right. At the bottom of this line of this document, in blue, you have the buybacks, the amount that they repurchase shares. And in orange, you have the dividends. What you can see is the sum of the dividend and buyback are almost equal to the free cash flow. That means all the free cash flow they generate is being paid to dividends and buybacks. They don't need capex. They don't have a lot of costs. They don't need a lot of capex to have new warehouses, new facilities, to implement AI like Microsoft or Google or etc. They don't need this. They don't need to reinvest in their growth. They have the infrastructure. It's like a toll booth and they just take the money everywhere. I would say to some extent 90-95% of the revenue is recurring. You have a very high retention rate and they take money every year. And as the world grows, you get more money and you can use all this cash to repurchase your shares in a flexible way. Meaning, as we said for other companies like ASML, management is telling you when the stock is cheap. They are doing more buybacks when the stock is cheap, decreasing its value, like the PE ratio is dropping. So management is flexible. Management is good when it comes to capital allocation. When the stock is expensive, they don't do any buybacks. Look at this. I told you in 2021, the stock went to the sky and the stock went up immensely. You have a PE ratio of 70, something like this. So very expensive. They just stopped the buyback. A little bit to offset the SBC, but a tiny bit of buyback. And then the stock dropped in 2022 and they pounced heavily on the buyback program. And what do you see now? You see more buybacks, more than $1 billion being paid to buybacks in the last 12 months. And the CEO is buying. The CEO of MSCI has bought shares for himself at several instances, including 2 days after this drop in 2024, like here, and one in another buying range in February 2025. What was the price of MSCI in February 2025? It was at 574. Now today, as I'm recording this video, it's 180, roughly the same. You know what? I bought MSCI at 2 instances, around here and around here. I have an average price of 550 or something like this. And for all these beautiful qualities, recurring business model that this business has, what is the valuation? So you can take a look at the forward valuation for the price to free cash flow. And here it is. As I told you, the valuation in 2021 was very expensive. like a very high PE ratio. The forward price to free cash flow was 50 at the time. Even if this is a very high quality business, this is very expensive. And then it dropped. It dropped. And I bought at a price to free cash flow forward of 27, doubled down here at 28. So that's maybe the cheapest valuation the stock had in 5 years. And for all the good arguments I told you previously, I think it's a pretty good buy. And that's the latest thing I have bought personally on my portfolio in recent weeks. So I love your pick about MSCI. I hope you liked this kind of analysis about MSCI. I think you have a lot of moat that reminds me of Fair Isaac, FICO. So branding, switching costs, economies of scales. You have pricing power, immense margins, very recurring, retention rate of 90%. I can even show you what I mean. You look at this investor presentation. I can give you, is it this one? 75 slides. I want to show you the recurring business model. Revenue, adjusted EBITDA. No. Let me scroll down. This is the run rate, index revolution, passive investing. Yes, as you have more flows into passive investing, MSCI will make more money. Let me scroll. Subscription run rate, retention rate. Okay, retention rate is 90%. You don't have churn. Customers stay. You can say whatever you want. Customers stay. And run rate growth, analytics. And you have growth rate. Only 25% of the revenue of this business is linked to the market. If the markets drop like they have dropped in 2022. Because only 25% of this business, of the revenue, is coming from AUM. Look at this, I can show you what I mean. This is why Fiscal AI is so great. Please use the referral link, it's a great website. You have this asset-based fees. So the amount of revenue that is generated when markets go up, when the AUM goes up. Look at this. And as a percentage of the total revenue, in the past, it was 16% and then 20% and then 20, let's say 25%. So when markets drop, like in 2022, only 25% of the revenue will be impacted. That means the remaining 75% of the revenue will be recurring, resilient. Even if you have a crash in 2026, stock market crash, they just don't care. People will pay like they paid the Microsoft Pack Office. And I can show you what I mean. If you look at the investor presentations, you can see the decline in 2022. Let me check. Is it this one? Recurring? No, maybe yes. Asset-based. Here we go. This is a line. In blue, you have the revenue from the index that came from asset-based. So when markets go up, like in 2020, 2021, more revenue. Because of more AUM, markets go up. And then in 2022, we entered a recession, we entered a bear market, markets went down, and this revenue that was linked to the markets went down. This is the growth rate negative. And then markets rebounded and it went up again, okay? So this is only 25% of the revenue that will be impacted. This is this blue line. For the rest, the subscription run rate, stable, 11% growth. The markets drop, okay, they don't care. 12% growth, 13% growth. They don't care at all. What I mean is 75% of the revenue, 75% of all the revenue are quite stable, resilient, with 80% gross margins. What do you think would be the valuation of this kind of business? I think it's a better business than average. So it deserves a better valuation than average. The PE ratio for the S&P 500. As I'm recording this video, let me show you the proof. What I say is like 29. Let's say it's 29 or 30. Do you think it deserves a PE ratio higher than this? My guess is yes. So maybe the PE ratio that is a little bit higher than average is warranted. Now for MSCI, the PE ratio, when I bought it was like 32, 35. Now the stock has rebounded since I bought. Lucky timing. I bought here and the stock went up 10% immediately. So PE ratio of 40 right now, forward PE ratio of 34, price to free cash flow of 33, and I showed you the forward price to free cash flow ratio before on FinChat. So a little bit expensive, a little bit of a premium, but I think it's warranted because of the quality of the business model. So I bought when the PE ratio was a little bit lower, like PE ratio of 30, 35. And I will hold. I think the analysts are underappreciating the quality of the assets. If you look at what is priced in for MSCI, I think it will grow by more than 8% per year. This is my take. Maybe I'm wrong. Maybe I'm right. Nobody knows. But if you look at the earnings per share for MSCI, what Wall Street is expecting here, this on Fiscal AI, you click on Estimates, EPS, and you put this toggle on percentage change. On Wall Street is expecting the earnings per share to grow 13% in 2025, 12% in 2026, and 13% in 2027. My guess is it will grow by more than this. It will grow by more than this because of all the levers they can have. They can do a lot of things to increase the earnings, and they have done this in the past. If you look at the past 10 years, let me check 10 years, the earnings per share, the diluted EPS of this business have grown 24% per year. And Wall Street is expecting this to be cut in half now. They expect the earnings per share to only grow 12% per year. In a world where you will have more inflation, more ability to increase your prices. I doubt it. And I think to some extent that Wall Street is wrong on this one. I think they can grow by more than this. So to some extent, it's cheap, undervalued. So I like your pick. All of this to say I like your pick. Okay, let me continue and let me move a little bit faster because we are moving at sub 10% allocation. I don't know how long this video will be, but we have a lot of stock to cover. So you know what, let me speed up a little bit because I don't want to spend the whole afternoon on this one. You will maybe sleep on this video. I mean, that would be good for the watch time, right? And but we never know. So let me see how it evolves over time. Amazon is roughly 10% of your portfolio. You don't introduce Amazon. They are everywhere. They are improving their margins. They have a great management team. You have AI that will be implemented inside all the segments. You have AWS that is growing massively. AWS profitability improving massively. Now you have a bit margin of 37% for AWS. Maybe I'm going a little bit too fast now. Okay, you have Amazon. Look at the financials, the KPIs. You have a few segments for Amazon, but over the years, the most profitable segments are getting bigger and getting more important in the thesis. And because they are more profitable, they are gradually lifting the overall margins for Amazon. So this is what, I mean, you can fact check what I say. The net margins of Amazon are up and to the right. And they don't, I mean, Amazon doesn't want this. They don't want any earnings to avoid paying any taxes. But the reality is, look at the net margins over time for the past 10 years. Net margins are increasing. Now we are at net margin of 10%. If I do this, what do we have change? 11%. And with everything that is happening with Amazon right now, more profitable segments, they don't want to hire anymore. Look at this. The employees, you don't have any more employees since 2021. They will implement AI that will do the work of an employee. They will have robots that will do the work of an employee. You will have a lot of incentives to increase efficiency in the future. And I can bet on it. I mean, Amazon is part of my portfolio too. So I think in the next 5 years, the efficiency of Amazon will grow a lot. Like a lot. And Wall Street is maybe not expecting this. Maybe we are quite aware of it, so maybe they are. And now the valuation is getting quite good. If you look at the forward price to free cash flow, same thing here. Price to free cash flow for Amazon is not a good bet because you have high capex. Let's look at the earnings. It should be fine. Operating cash flow should be fine. Earnings should be fine. You have a PE ratio forward of 35. So again, a little bit of a premium compared to the S&P 500, but do you think it's warranted? I think Amazon has the potential to be the biggest company on earth. They are everywhere. Now the market cap is $2.4 trillion. It can reach $5 trillion easily. My guess is easily. It's only a double. If they grow, I mean, it can take 3 or 4 years. They can grow 20% per year if they want to. But the management is great. Andy Jassy, the new CEO, I definitely recommend you watch all his interviews. I took the responsibility as a shareholder in the last months actually to watch all interviews of Andy Jassy, the new CEO of Amazon. Great interviews. You learn a lot of things. I've read all the letters of Jeff Bezos during the lockdown of 2020. So I've been following Amazon for a while and now became recently a shareholder in late 2024, I suspect. When was it? I'm not sure. But after COVID, after a while, when valuation became enticing, and I think the future is bright. Now Jeff Bezos is back. So we are working hand in hand. Andy Jassy and Jeff Bezos, two beasts of capital allocation, managing the debt very good, very easily. The revenue will continue to grow massively. The profitability will increase because now segments are very profitable and they will become more profitable because of AI and robots. So yes, CapEx is big. Yes, you have long investment cycles of 7 years. They want to invest in the next big thing. But in terms of powerhouse and future business, Amazon will be my top one in terms of market cap in the world in the coming years. I wouldn't be surprised at all. The two contenders, the two potential ideas, in my view, that can be $5 trillion, maybe 3 now. Microsoft, Amazon, Nvidia. These are the 3 that have the potential to become really big first. After this, I mean, Oracle can be here, Meta Platforms can be here after this. But in terms of the first ones together, Amazon would be my first position. So I like it. Next one is Google. I will be short on Google. You all know Google. You all know that it is getting threatened now because of AI and ChatGPT and all the LLMs. And Amazon and Google is forced to cannibalize itself. Now, half of the revenue from Alphabet is coming from search. But the search engine is in danger right now. People don't want to look for answers and click on the blue links. They want the answer immediately. So LLMs, chatbots, ChatGPT, this is the future of search. And in the past, you had a lot of hallucinations. ChatGPT gave you some strange answers, but now they just browse the internet and the answers are pretty accurate. So the new way of looking for information is through ChatGPT. Alphabet has struggled so bad to have another ChatGPT. If you want to have some fun, you can look at what they did with Bard, with woke images. You say to Bard, give me an image of Vikings. And they give you black females having axes. Okay, Bard, give me an image of the founding fathers. And they give you black females writing books. So all this woke scandal didn't go well with the branding of Alphabet. So they went slowly and they slowly implemented Gemini. And now you have Gemini in full force, full implementation. They go really fast. They put a lot of money in Gemini, but it's not really monetizable. So you are forced to cannibalize your search engine to now go to Gemini. But Gemini, for the moment, is less profitable than the normal search engine with blue links on Google. So you are forced to cannibalize yourself to become a powerhouse in the future of search. So you have competition, ChatGPT, that is burning cash and unprofitable, and you have a brain drain out of ChatGPT to other tech businesses. So maybe in the future, the search engine will be in real danger. So far, we are in the how do you say it, in the battlefield zone, no man's land. Nobody knows what Google will do in the future, if they will win the AI race or if they will lose because they will cannibalize themselves. It's less profitable, so it will generate less earnings. Nobody knows. And even Wall Street doesn't know. Nobody knows, actually. I don't know. I own Google, and this is the only risk I see for the business. This is the most profitable business on earth, I think. The net income has reached $100 billion, so they know what they're doing. You don't bet against Google. They are filled with cash. They are doing some buybacks here and there. They don't have any debt. You have a growth engine. They have YouTube. They have the Android segment. It's not only search. They have the cloud that is now profitable. And you have a little segments, small bets like Waymo that for the far future will maybe do something. But what is important is the cloud, is the search, is YouTube, is the ads service in general. We will see. It's a double-edged sword. I will not be that confident for Google in the future because nobody knows. So I have some doubt. I would be much more comfortable owning Amazon compared to Google. And that is the reason why Google is cheap right now. The PE ratio for Google is 18, 19. Yeah, people know this. People know that it's a beast that is in danger. And that is the reason why the stock is not going to all-time highs, because they know they are in danger. They know that the stock is having some big issues. And the founders of Google came back to the business. They don't like the retirement. They wanted their brain. And again, if you want to have more information about the founders, the acquired Google. You have this podcast that was released in late June 2025 from the acquired about the first years of Google as a search engine. And the two founders are great. You don't want to bet against them. So it will be pretty interesting, but it's quite intense. And I would not like to be in their shoes. Next one, Nvidia. Nvidia will be pretty short because I have not a lot of opinion about Nvidia. What they did is just wonderful. It's, the data center segment is quite new, growing nicely. Now it's a growing beast. They have immense pricing power, but to look at the charts, it's quite frightening. I would be quite scared if I was an Nvidia shareholder. The revenue shot up to the sky very recently. The net income went up in an exponential way. The free cash flow went up in an exponential way. The same way it went up a lot, can it go down a lot? I have found zero reasoning that would deter this scenario from arriving, from committing. So margins are all-time high. Margins are very profitable. They are clearly a leader in their category. And the leader, Jensen Huang, is a genius, complete genius that is winning. And if AI drives the world of tomorrow and you have zero competition, Nvidia will make money, like a lot of capital, a lot of money, a lot of earnings, and a lot of cash flow that would be very rewarding for shareholders. So if you have another leg up for the stock, it will become a $5 trillion business faster than Amazon because of the growth. I mean, this is just spectacular, the kind of growth they have done. And the valuation right now, if you look at the forward PE ratio, because of the growth that is estimated in the future, forecasted, PE ratio of 37. Not that expensive if you think the business will continue to grow in the future. And I have my doubts. I don't know. Nvidia is outside my circle of competence, so I will not touch Nvidia, and I have no clear opinion about Nvidia. So good luck holding it. You can expect more volatility and a lot of drama, but that's the life. That's the life of holding Nvidia. That's the life. That's a wealthy life, by the way, because the stock shot up very recently. Shot up a lot and made shareholders and employees very wealthy. Let me continue. TSM, same thing. I will be very short on this one. Clear leader. You have a very nice position when it comes to the moat. Big company, $1 trillion of market cap. Taiwan invasion is the main risk, but it's a clear leader available at a PE ratio of 25. So up and to the right, very cyclical, but generating a lot of free cash flow. They don't have any debt problem, and they are very efficient. It's a good bet if you want to bet on the chip industry. I have favorite companies that are maybe more simple to understand, but for this one, I would not bet against TSM. That TSM is 8% of your portfolio. Next one is Mastercard. Oh, now we are getting into smaller positions. So we try to be a little bit faster. So the video is not 3 hours long. Mastercard is 5% of your portfolio. I like it. It's a recent buy from me also. I mean, some quarters ago. Mastercard is unkillable. That will be my pitch. Mastercard wins at every stage of the way. Mastercard wins if you have inflation. Mastercard wins if you have recessions. Mastercard wins despite the US administration. Mastercard wins despite all the geopolitical tensions. Mastercard wins if you have an AI revolution. Mastercard wins if you have an data center build out that is just a waste, like cable companies in the 90s. If AI is a fad and unprofitable, it can happen. If AI is unprofitable, people will stop the investments. Mastercard will win. You know why? Because they don't have any costs. Because they don't have any capex. And they generate more free cash flow, more revenue, more earnings every year. They make more volume every year, more transactions every year, more take rate every year. For every transaction, they make money. And you had competitors that came for Mastercard. In 2025, you have rumors of stable coins. You know what? Mastercard embraced the new technology. They partnered up with other banks to provide stable coins. So the stock dropped for some reason because of stable coins. Here we go. And then we rebound because they just embrace every technology. They are very smart, very profitable, gross margins at 75%, net margins of 45%, free cash flow margin of 50%. If you look at the charts, everything is very profitable. Revenue up and to the right, net income is up and to the right. They don't have a debt problem. They are generating more free cash flow every year. And similarly to MSCI, most of the free cash flow, almost the majority of it, is being given to shareholders as buybacks. You see that they are buying back 2 or 3% every year. You see here the green charts, 2% buyback of the shares every year. And dividend, a small dividend, like less than 1%. So you have an exemplary business model that can't die, available at a forward PE ratio of 35. Similarly to MSCI, it's a superior business model that deserves a higher valuation. Maybe it's a tiny bit expensive right now, but I think that's warranted. So it's a hold for me. I will not buy Mastercard at current levels, but I will not sell it. I will not sell it. And it's a defensive play. Similarly to MSCI, right? If you have a slowdown in the economy, Mastercard is safe. If you have a recession, Mastercard is safe. If the stock market drops and we enter a bear market, Mastercard is safe. They will still be profitable and make a lot of transactions, take rate improving, etc. So very, very good investment. Maybe you want the business to drop a little bit to buy more. AMD, I will be a little bit shorter. I'm struggling to really understand the business. And the analysis will be a little bit shorter than Nvidia. I don't know if I can put them in the same basket. I have read a lot about AMD. And I'm still struggling to understand the business. So I have no opinion. It's definitely out of my circle of competence. Same advice for you, subscribers of this channel. First, thank you for watching my videos. We are a small YouTube channel, quite hidden. I like it this way. We are a small community with friends. Your comments are always nice, so thank you for this. 2, only invest inside your circle of competence. Don't try to be a genius. Don't try to be smart. Don't try to find the next golden opportunity. No. Stay inside your circle of competence. Only invest in what you understand. I understand Mastercard. I understand MSCI. I understand Google, Meta Platforms, Amazon, because we are a daily user, okay? But AMD, I have no clue. And for this reason, for me, it's a pass. I will not buy, so I have zero opinion on this one. Now, Ferrari. I hope I was a customer of Ferrari. I hope I had... I wish I was a customer of Ferrari. I wish I had a Ferrari. My life would be greater. I don't think so. I don't know at all. I'm fine with my car. Ferrari is great. Ferrari is beautiful. Ferrari has the best branding ever. You have a company that doesn't need any marketing and everybody knows the brand. And you have a backlog of 2 years. Clients want a Ferrari 2 years in advance. Everything is sold out. And most of the clients, most of the revenue coming from Ferrari comes from already customers, people that already have a Ferrari, already a Ferrari owner. So it's an inner circle. And again, we live in a world with inflation. So to offset this inflation or any tariffs from the Trump administration, by the way, Ferrari is increasing their prices. You can check on the internet. They have published it. It's public. So the prices for their cars will go up massively. And you know what? Customers will love it because they will be in this inner circle of highly privileged car owners. They like to be inside this circle of people that know themselves. You have a Ferrari. Wow, it's so hard to have a Ferrari. Prices are so high. The backlog, the time to wait to have a Ferrari is so long. People, customers are very happy to pay more. This is the best kind of customers you can have. Customers will gladly pay you more and never complain. And this is exactly what is happening. So if you had invested in Ferrari when you had a spin-off from Chrysler in 2015, you would have made a lot of money. It's a 10x in 10 years. I mean, that's the best kind of situation, right? A 10x in 10 years is the best kind of scenario you can have. So Ferrari, to that extent, is a S-tier category stock you can wish for. The only problem for Ferrari is not the business model, it's not AI disruption, it's not EVs, it's not regulation. It's only the valuation, not the regulation whatsoever. The valuation is very high. A forward PE ratio of 45. Maybe it will be a little bit lower because they can increase their prices. But PE ratio of 50, quite high. You know what? At a forward PE ratio of 35 or even 40, I would be tempted. But right now, I would not be a buyer. Congrats if you bought before. You have a gain of 5%. So maybe you bought recently and the stock went up or something like this. So you agreed that you pay up. Okay, I mean, congrats and bon courage. Good luck, as we say. We will see. They have a big capex to have the best cars ever. They don't have any debt. They don't have any management issue. You have great owners, small dividend yield, small buybacks here and there. But the story for Ferrari is very, very, very simple. I mean, you can pitch the Ferrari thesis to a child and they will understand very easily. The only worry is the valuation, and right now is expensive. To my opinion, okay, right? Some people will say it's not expensive, but this is my video, so I do whatever I want. Next stock, it's United Health. Oh, the analysis will be way shorter. United Health, I'm not American. I don't know how the healthcare system works over there. I mean, I know how it works, but I'm definitely not an expert. I'm French. I have a strong French accent. This channel is called The French Investor. So this is way out of my circle of competence. You have a change in management. I don't know if I can say what happened publicly on YouTube to not get banned, but you have a change in management for United Health and you had some regulatory concerns. To that extent, that's even further away from my circle of competence. I don't know what can happen. The stock got destroyed, so we are in a value territory. If you are courageous enough to buy right now, please know what you go into. So it's tricky, and for me, not my style of investing. I will not sleep well at night if I bought United Health right now. But the stock has a moat. I mean, it's big, revenue is increasing, net income is increasing. They don't have a debt problem. They generate cash flow. They give a dividend. Fundamentals are okay. I agree with you. The valuation has a P ratio of 12. It's cheap, yes, but I'm not comfortable owning it. So you wanted my take? Here it is. Weight out of my circle of competence. To know, another quick tip for you guys. Thanks for clicking on my videos. To know if something is inside your circle of competence, ask yourself, if the stock drops 50% next month, will I know why? Will I know, oh, that's because of this. Oh, that's because of this. Oh, that makes sense. Okay. For some companies, including United Health, as a French guy, I don't know at all. I don't know. I kind of know, but I'm not really sure. For other companies, you know exactly what went wrong. So this is inside my circle of competence. Only if I know what are the reasons that make the stock go down. Oh, the stock went down because of this. Boom, inside my circle of competence. If you don't know this, that's outside your circle of competence. To some regards, that's also the reason why I don't invest in Bitcoin and other cryptocurrencies. If the Bitcoin drops, if the Bitcoin prices drops tomorrow 30%, I wouldn't know why at all. So for that reason, I will not be invested in cryptocurrencies. I will only invest in companies that are profitable, that are inside my circle of competence, that can really understand, very profitable, very high quality, available at a fair price. So when it drops 50%, maybe I can seize the opportunity and buy more. And this is how you outperform. This is how I made 25% per year. This is the simple process I use to just be very strict on your guidelines, how you invest in stocks, what are the quality KPIs you look for. So when something is inside your circle of competence and it drops significantly, you are ready. I can give you an example. With Fair Isaac. It will be quick. I will go to another stock just after this. FICO stock. Let's say FICO stock, FICO, Fair Isaac. I know this company really well. I think it's pretty easy to understand what they do. And the stock is getting hammered year to date. Look at this. Not even year to date, but we are in a drawdown of 30%. I think the price is a little bit too high right now, so I will not buy at current prices. But if it continues to drop, I will buy for sure. I'm very happy to buy. It's inside my circle of competence. Another example is TPL. Inside my circle of competence, I have been a shareholder of TPL for 8 years. For 4 years, sorry. It was 8x. I multiplied my investment by X in 4 years, sorry. I've been following this company for a while. And it reached an extremely high valuation, very expensive. And since the peak, it's a drawdown of 40%. If it continues to drop more, I will buy it. I'm very happy. That's inside my circle of competence. But now, for United Health, I don't know at all. I don't know at all what will happen for the company in the future. So, for that reason, I'm out. I'm out. So, I mean, I hope this is inside your circle of competence. You are German, so maybe you understand this better than I do. Next one is KLA Corp, and I will. It's 1% of your portfolio, and you have also Lam Research, 1% of your portfolio. I will go quite fast on this one because we already talked about the chip industry. So you have specialty component companies in this chip industry. KLA is the largest semiconductor wafer fabricant equipment. Okay, the company is cyclical, like the whole industry. And out of the bunch, you have a few competitors here. I mean, they operate similarly. KLA Corp, Lam Research, ASML, Tokyo Electron, Applied Materials. I would say these are the top 5 investments you can make in this industry that follows the same trend. Very cyclical, they follow the same waves. Very high margins. The revenue is up and to the right. Net income up and to the right. No major debt issue. And they do buybacks with a lot of free cash flow. Life is good, right? The PE ratio for KLA Corp is a little bit lower than ASML. And I suppose that's also the reason why you invested also in KLA Corp, because it is in a similar industry, but a little bit cheaper. Forward PE ratio of 27. And with that said, it reached all-time highs. So I suppose you bought a little bit earlier. Let me check. KLA Corp plus 20%. So yes, you bought maybe here. You bought when the PE ratio was not, the forward PE ratio was not 27, but 23, 24. So a leader in its category for a PE ratio of 24. This is very good. I've made videos on this channel about applied materials and this whole industry. I love this industry. And it is also the reason why in my portfolio, I own Lam Research, that you also own, Amin. Lam Research, ticker symbol LRCX. Similarly, it's one of the largest semiconductors wafer fabrication equipment manufacturers in the world. The chart is the same, the stock price is the same, looks the same, but it's not the same. This is a company with very high margins. Similarly to ASML, you need to operate in a very clean environment, very regulated. You don't have a lot of competitors, and the earnings are fine. Revenue is up and to the right, very cyclical. Same thing for the free cash flow, and they do buybacks. Buybacks when they think the stock is cheap. Okay, no debt problem. Life is good. It's a bet on this industry growing. Available at an even cheaper price. Forward PE ratio of 24. And with that said, the stock has rebounded. I bought the stock at 80, I think. 80 on the way down, and then I doubled down here. So 80, and now it's 100. Oh, it just reached 100 today. Okay. So yeah, I love it. I love Lam Research. And for all these companies, by the way, Amat is in the same scenario. They clearly say, we are riding this wave of AI. We see more demand in the future. Yes, it will be cyclical, but we are here for the long term. And we are well positioned. And most of the free cash flow will be to reward the shareholders. Thank you for trusting us. If you look at all these guys, they give plenty of dividends, plenty of buybacks, and they clearly say it. Most of the free cash flow will be given to shareholders. Applied Materials, same thing. High margins, a little bit more slower, and more and bigger, more diversified. So they are bigger, more diversified, growing less. So it's a cash cow. It's a cash cow, and they do more buybacks compared to the other ones. So here we go. You have another investment idea, Applied Materials, available at a price PE ratio of 19. And with that said, the stock has increased here, rebounded. So you had this available at a forward PE ratio of 15. 2 months ago, 3 months ago. So very good. Do you have Applied Materials? Materials. I don't think so. Okay. Okay, let me continue. And now we are talking about positions that are very small. So we will continue, but it will be much quicker. So you can do something else with your life. Linde. I have come across this company very recently, but I don't know this company. So it will be a great discovery for all of us. Linde is the largest industrial gas supplier in the world, with operations in over 100 countries. They supply gas. Okay, out of my circle of competence. I'm out. The stock is beautiful. And I don't know when you bought the stock. You bought at current prices, so you're flat. The margins are quite high, actually. It's a very profitable business. Net margins of 20% for a gas supplier. If you look at the revenue, it went up massively in 2019 and growing a little bit. The debt is growing more than the revenue, so maybe that's something to monitor. And what about the free cash flow? The free cash flow is growing over time. You have a long-term trend. Very well. I suppose they did an acquisition here. They made an acquisition in 2018. This is the reason why the revenue went up. Look at this. They diluted the shareholders. They doubled the amount of shares. Look at this. In blue, in 2017, they had 300 million shares. And in 2018, they had, let's say, 500 million shares. So almost doubled the amount of shares. And if you merge with another company, you increase your revenue. But it impacts your return on invested capital and you get more debt. Let me check. Linde PLC acquisition 2018. Yes, they acquired Praxair. What is the price of the acquisition? What? 90 billion? I don't know. No. They receive shares. Maybe that's this one, or maybe that's another acquisition. I think the revenue increase was just because of the acquisition. And since then, revenue is struggling to go up. So that's a bet on gas. Gas supply all over the world, available at a forward P ratio of 28. Price of free cash flow of 45. Yeah, okay. I'm not that interested in this one. So good luck owning this one. Wish you the best, but really out of my circle of competence. What do I know about gas supply, gas transports? Now, Novavax, Nvax. Let me check this one. Okay. What is Novavax? It's a biotech that develops vaccine. Oh, now we enter speculative territory. I praised the first picks of your portfolio. I will destroy the least ones now. I'm just kidding. For this company, it's a biotech, so obviously it's very speculative, highly speculative. Depends on the trial 1, 2, 3, regulation, etc., etc. You burn a lot of cash in the hope of getting one vaccine right. So apparently it increased massively, the revenue increased massively in 2022, and the losses increased massively during the process. The company was never profitable, and for that reason I will never invest in this company. Yes, they don't have a debt problem. They are diluting the shareholders to create more cash. So if you are a shareholder of this company, in the purpose of getting this vaccine out, you have been diluted. Dear shareholders, the management team wants to dilute you to finance their operations. And the company was never profitable. And if you look at the free cash flow, they only generated 1 year of free cash flow in 2021, $200 million. And next year, they burned all the cash. And after this, burn all the cash. Do you have a reversal now? Free cash flow, not that much. Most of the time is generating losses, and the stock has been completely destroyed. Wow. When I don't know what happened in 2020, 2021 for this one, but the stock went up a lot, maybe because of a new discovery. And like all the biotech companies, they struggle to thrive. They are not generating any money, and for this reason, I'm out. Next one, Intuit. So we are talking about software now. Intuit, I'm definitely not an expert when it comes to Intuit. I know it's a promising company with a moat. They have a problem with their SBC, but they can implement AI everywhere. It's a big company, software, very profitable. In case you don't know this company, Intuit serves small and mid-sized businesses with accounting software, QuickBooks, and online marketing platform MailChimp. Maybe you have used one of them, either QuickBooks or MailChimp. And financials are great. Revenue up and to the right, net income up and to the right. They have a little bit of debt, but that's not an issue. They are generating more free cash flow every year. They have a lot of SBC, but that's normal for a software company. And they are available at a forward PE ratio of 33. I'm not very at ease with this business, to be honest. I know the fundamentals are great. I know a lot of super investors are invested in Intuit, but I've never been seduced by this company. Maybe one day, but for the moment I have zero opinion. Congratulations. It's a good business. The price, the valuation is a little bit too high to my taste, but I don't know the quality of the moat, etc., etc. I'm not that sure. Let's move on. Lam Research, we already talked about this one. Accenture, I don't like it. I'm telling you straight away. I don't like Accenture. I think they will be destroyed by AI implementation, and I don't like this industry at all. Accenture, in case you don't know this company, it's a leading IT services firm that provides consulting, system integration, and business processes outsourcing to enterprises around the world. The consulting industry will be disrupted by AI. That's my opinion. And for this reason, I will never invest in this kind of consulting businesses. I've seen so many examples of consulting businesses that went to dust and that are not growing anymore because of AI. So yes, margins are decent. Forward PE ratio is 22. People are seeing the risk for a business that is still growing, net income, revenue, but I think the growth will slow down. It's a stable business. And did we have a shock in net income? I don't know. I read their latest earnings report and I was not satisfied at all with the future growth prospects. So I don't like Accenture, but good luck holding this one. If you think consulting is still alive and will be helped by AI, good luck to you. I don't think AI will help Accenture, but maybe I'm wrong, as always. This is not the truth. I'm just speaking my mind. Maybe I'm wrong on this one. Out of all the opportunities you have in the world, Accenture will not be my go-to bet. Next one, Monolithic Power. Okay, MPWR. MPWR. Is it a buyback machine? I know this company for being a buyback machine. Not at all. It's a dilution machine. It's a company without any debt, a growing revenue, a growing net income, and the net income was multiplied by 4. Is it an energy play? What do they do? It's an analog and mixed signal chip maker specializing in power management solutions. No, I don't know this company. The firm's mission is to reduce total energy consumption in end systems, and it serves the computing, automotive, industrial, communications, and power end markets. Okay, I would say from the first point of view, it looks out of my circle of competence. I don't really understand what they do, but the margins look great. Forward P ratio 44. Now the P ratio is 20. So maybe they had 1 year of big profitability, and it will go down in the future. Oh, look at this! Wow, what is this? In the fourth quarter of 2024, you had 1 year of huge net income. Most of the time when you have this, it means you sell out of a position, maybe an accounting change. I'm not sure what happened to this company in late 2024. A divestiture 2024. I don't know at all. Inside the sell-off. No. I don't know what happened. Maybe an accounting change. What is happening here? We introduce this. Divest. No. Sell. No. So maybe it's an accounting trick. And it will... Maybe Guru Focus is wrong on this one. I don't know. Let me check another website like Stock Unlock. Stock Unlock, income statement on a quarterly basis. What do you have when it comes to net income? No, you have a spike for 1 quarter. Okay. Revenue, no spike. Cost of goods sold, no spike. Operating expenses, no spike. So the EBIT, nothing. Net income and taxes. This is it. So you had a special treatment of taxes, I guess, and you had $1 billion in more profits just because of a tax change. So I'm curious now. So you piqued my interest. Let me see what has happened. Investor relations. Let me go to Q4 2024. AI summary. Do I have this one? Share buyback. Yeah, they are doing share buybacks right now. Share buybacks. Buyback is new for them. Let me check the report really quick. Let me scroll down, see whatever they have to say. Revenue, GAAP gross margin. No. I want something about tax. Let me do Control F, tax maybe. I can check tax here. Okay. What do they say about taxes? Non-GAAP income. A tax benefit of $1 billion. Do they say why? No. Let me check. It will be interesting for everybody. December tax, no. Tax benefit granted to a foreign subsidiary. What? They had $1 billion for the recognition of a tax benefit granted to a foreign subsidiary. So it's not the mother company that had the tax benefit, it's a subsidiary abroad. A tax granted for the foreign subsidiary. Next one, no. Tax effects. No, they don't talk about this here. No. For a foreign subsidiary. Do you say why? What happened? What happened? That's a non-GAAP tax effects. I don't see any comments on what is happening with your tax. Anyway, maybe you have to adjust the PE ratio. And maybe this is the reason why the PE ratio is so low right now, with a PE ratio of 20. You have to adjust it because it's a one-off benefit that will not occur in the future. So if you adjust it, maybe the PE ratio is not 20 but 40 or 50. Next question is it warranted? Do you know if this is a superior business model compared to competition, etc., etc., etc.? I don't know at all. They have no debt. Yeah, it's a subsidiary. Okay. Let us continue. If you look at the revenue for this business, it's growing nicely. So it looks like a healthy business model, but I have no opinion about this one because I don't know this company. Let me move on, and that will be the end of this video. You have Copart, tiny position, 1% of your portfolio. I like it. Copart is great. The stock has dropped recently. It's about auction to buy a car, an online salvage vehicle auction with operations in 11 countries. It's a big compound and the stock is down because of bad guidance, bad results. But I like the company a lot. Good for you that it's a starter position, because now the stock has dropped to a more reasonable level. So I like it, Copart. Did you read the book? I think the book is here. Here we go. Junk to Gold. The history of Copart. Did you read the biography? For anyone who wants to be a shareholder of this company or is a shareholder of this company, please read this book. It's a short book. It's very thin. You have 150 pages, and it's great about the mindset about Copart. I like it. ODFL, I like it. Again, it's a starting position, so I don't want to take a lot of time about this one, but it's about a less than truckload company. ODFL, second largest less than truckload carrier in the US, following FedEx Freight with more than 200 centers. So it's trucks that are not filled completely, less than truckload. It's better for flexibility. I have analyzed this business a couple of years ago and did not buy it because of the valuation. But it seems like the stock has done nothing and the valuation came down to reality. Forward P ratio of 32. For the same valuation, you have ODFL about trucks and ASML about chips. Pick your winner. This is a business that is growing sustainably, revenue up and to the right, net income up and to the right. This is what we like. They generate massive free cash flow and they do some buybacks. So I like the business model, but I would prefer ASML actually. I think the growth engines are much more powerful right now. And if you look at the trucking industry right now in the US and in Canada, is not that great. You have a few players in the trucking industry. This is very boring, and I had some great fun analyzing this industry. You have ADFL, you have Seiya. Same thing, you have a stock that is dropping because similarly the trucking industry is in a bad shape right now. You have XPO Logistics. They're rebranding themselves just for XPO. The stock is not dropping. Interesting. Maybe they are different to some extent, but they are not thriving, let's say it this way. You have TFI International in Canada. Same thing, a trucking business. I'm giving you plenty of tips. You watching this video, do the work now. I'm giving you all the stock tips, all the stock tickers. You have your turn to do the due diligence now. Same thing, it's about trucking, and they suffered. The CEO of CFI is great because he's very blunt. So you have a lot of fun when you listen to him. And they said it was a disaster. So the whole industry is in a shambles right now. Let me continue. If you want me to help you find these stickers, as always, you can book a call with me. This is the first link in the description to book a call with me to do this kind of analysis, but for your portfolio. Like, we can have calls like this. This is what we do in the coaching program. We analyze businesses from everybody's perspective, like individual's perspective. Bio and tech. Oh, it's about biotech. Come on. BNTX. Biotech company in Germany. You couldn't be more outside of my circle of competence. I don't like the biotech industry at all. I think that's a very good way of having anxiety and stress and not sleeping well at night. The net income is dropping like a rock. The revenue is dropping like a rock. We are about quality. So for all these reasons, I'm out. And I'm not forecasting a lot of things. I'm not forecasting a lot of great things for all the biotech stocks. This is a typical value trap for all the new investors to invest in a lot of biotech. This subscriber, is not falling into this trap because biotech companies are not the majority of his portfolio. But sometimes I see investors investing in value plays, and they invest a majority of their portfolio into biotech. And then they cry because it's very hard to operate in this industry. I have analyzed this industry from a distance, and it's very hard. A lot of biotech investors suffer greatly with a lot of anxiety. So I don't like at all. I don't like these picks at all. Now Adobe, and we are talking about small, tiny starting positions, 0.5% of your portfolio. For Adobe, I know the company really well. And I think they are in danger because of AI. Similarly to Google, but to a greater extent. I don't like Adobe. I know that some people like Adobe right now because they still have a moat and the revenue is still growing. Yes, they have a recurring business model. They have a software, a license that is very good for professionals. But for retail people that want to use Photoshop, like Adobe is Photoshop, all the video editing, etc. You have Canvas that is taking a lot of market share for individuals. So Adobe is more about professionals now. And they don't, they kind of implement AI into their solutions. Not that much, but they are embracing AI technologies. And they are using all the free cash flow to do buybacks. So they don't think they are in danger right now. All the free cash flow is being paid as buybacks. So again, it's a double-edged sword. Either AI will help them, and they are very smart about doing the buybacks, or they are in danger and they will fail. And for this kind of uncertainty, I am not a buyer at any price of Adobe. I think the moat is in danger right now. As a user, I've done video editing for 15 years. I know very well how the industry works. And I've been doing video editing, short films, etc. Since I was very young. So I know the power of Adobe. I know the ecosystem. And despite this, this is clearly inside my circle of competence. And I don't like this setup. So maybe I'm wrong again, but I would not take the side of this bet. The PE ratio is roughly 20 for a business that is very high margin, profitable, a lot of free cash flow, buybacks. But I think the moat is in danger. Let me continue. Bitcoin, no opinion on this one. You do whatever you want with your money. This is a channel about stock picking, so Bitcoin is not a stock, so I will just skip it. And now we are talking about small positions. You know what? Let me do one sentence per positions because we are really tiny. Reset Networks, it could be a great hedge for infrastructure in AI. Novo Nordisk, you have a lot of uncertainties. Be sure of what you invest in this segment of diabetes, Ozempic stuff. You have a lot of competition. You have some new regulation, but the stock is cheap right now. They have a new CEO, new management team, but still the stock is not recovering. So Fundamentals are good, but the recovery is uncertain. We don't know with the new management. Auster, I don't know this company at all. Let me do a quick check. Auster, a provider of LiDAR sensors for the automotive industry. Very speculative in my opinion. Do they make money? I don't think so. Here we go. No, only losses. 0 profits for this company. For this reason, I'm out. But you invest for the future of autonomous cars, I guess. So revenue is increasing, more dilution for the shareholders, 0 cash flow. Yeah, you invest in the future, so it's a speculative position. Nasdaq US Biotechnology. I guess you have an edge in biotech, which I don't have, so this is why you invest. And PowerTap. Oh no, you have 0 position, 0 position. So be it. We did it. Wonderful. Congrats to everyone who stayed. Let me do a quick sum up. This is a very decent portfolio. I like the starting positions, how safe they are. Very high quality, and then as you go deeper into the portfolio, you enter more into speculative territory. So maybe you have a little bit too many positions to my liking. You can cut some of the positions. You have my opinion now, but congrats. That's a very well-run portfolio with the biggest positions being the safest ones. That's the main takeaway for you watching this video or anyone watching this video. Your biggest positions should be your safest ones. You don't want to have your biggest position, like 15% of your portfolio, that can be cut in half. That's just disastrous for your performance. You don't want much volatility for your best performance, your biggest performance here. So very well run. I'm forecasting great stuff for your future. I mean, you have 300K invested. It can grow to $500,000. And $1 million and $2 million. Just be patient, but you can generate some good alpha with this one. Some hedge, some AI exposure, some small starting positions that can improve in the future. So congratulations. And as always, for anyone watching this video, if you want me to review your portfolio or if you need any help to analyze businesses, to improve your portfolio, you can book a free call with me. You have the first link in the description to book a free call with me to see if we are a good fit working together, to see how I can help you. Don't hesitate. I'm here for that. I built this YouTube channel to help you being better investors, improve the outperformance in the market. I've generated some alpha in this market, so why not share it with you? So it will be pretty fun. We can work together. Just book a completely free call in the description, and I will see you on the other side.